Good morning, everybody. Welcome to my section of the workshop, the first of the week, and probably the more important one. A number of things going on this morning. Some technical things I need to let you know about. I don't know whether Adrian has let you know just yet. Firstly, daylight savings. Cliff, hi there. We've had our daylight savings. We used to call it British summertime and wintertime and all sorts of stuff, but this American description seems more accurate, isn't it? Daylight savings. That's the interesting day ahead, Cobus. Well, I think it is, yeah. Well, it's definitely interesting if you live on the eastern seaboard in the US, that's for sure. The Americans changed their clocks on the 4th of November. Which means we now have a difference of 4 hours, not 5 hours. So, if you're looking at the Forex calendar, I'm just opening up the Forex calendar from Forex Factory. If you're not careful, you'll have what is set here, which is saying the time is 9:18 a.m. We all know it's not 9:18. It would have been on Friday. It's now 8:18. To change it, if you want to get that right, just click on the time. And for the time being, until the US's daylight saving comes in, if you turn daylight savings off and then click Save Changes, you'll now see that it's got 8:19. So that's the best way to get that in check, which means when we look at our calendar, we get the correct times for things. But anyway, the change in times means that equities, if you are a follower of the US stock market, that opens at 1:30 instead of 2:30. Data releases, well, remember, for example, we're going to go on about this in a few minutes, but for example, Nonfarm payroll, which we all these big numbers we tend to see at 1:30, it'll be coming out an hour earlier, at 12:30. So that's the first impact, and I talk about stock markets opening at 1:30. Of course, the US stock market is shut today, and I don't know whether many of you know that. It's not shut for any holiday. It's shut for the massive storm that's brewing, the storm of the century, the one-off. I heard Adrian referring to it. It's dubbed the Frankenstorm. Which is some beast that's now stretching some 1,000 miles across. If we quickly scan the headlines, fear of Sandy shuts markets and flights on the FT. Hurricane adds uncertainty to US election. Hurricane Sandy shuts down markets. From Reuters, US East Coast shut down as Hurricane Sandy looms. This is big. I mean, it is really, really big. And typically what tends to happen when there is this uncertainty hanging over the market, and this could disrupt, forget about just disrupting travel, etc. This could disrupt commerce for a little while, not just a day. Think of what happened when we had a day's worth of disruption in the UK with the Queen's Diamond Jubilee. So it's quite serious, and obviously this is something that's coinciding with a winter storm coming in from the north. It's full moon, high tides. This is, as I say, it is what they call a perfect storm Mark II. Will, short the airlines, banks, the lot. Well, yeah, banks in the UK, because they've, for some reason, miscalculated the PPI, but that's typically what's happening, though. Well, I do agree. That's my first reaction, is to take cover. And there wasn't a lot happening overnight, but the S&P is down, 6 3/4 points already. So there is a certain amount of risk being built in here. FTSE is picking up a little bit off the lows, but yeah, it's going to be an interesting day or two. I don't think the hurricane is due to hit until later this afternoon, US afternoon, which is our evening, and overnight our time, i.e. evening in the States. So we may not know the full effects of what's gone on until tomorrow morning. Review of last week. Well, we should be blowing our own trumpet here. We've pretty much hit this one. We have felt there is little justification to buy the market for now, and certainly the FTSE shared, 90 points, 1.5%. The Dow was off over 230 points, which is 1.7%. Conversely, bonds, gilts, bunds, that's the UK gilts and the German bunds, they have rallied as the risk off trade carries more weight than the risk on trade. So less of buying equities, more hunkering down and putting on a defensive position. So bonds recovering. Gold down $10 last week. What's that, sort of 0.75%? Crude oil sort of mixed on the week. But yeah, an interesting week. If we look at the calendar from last week, just go to there. It's quite easy to look at the calendar. You just click on a different week if you want to see what's gone on. But manufacturing PMI, remember those ghastly numbers in Europe, lower than expected. German manufacturing PMI a lot lower than expected. Then we had that German IFO survey last week. Was expected to come in roughly the same as the previous week. That came in weaker. Conversely, US numbers were okay. Home sales were pretty much on the money. Durable goods were better than forecast. And on Friday, the prelim, or they call it the advanced GDP, that came out at 2%, slightly better than expected. So I hear you asking, why has the markets come off? Why have the US markets come off? Any takers, please? Go on, someone be brave. Come on, Will, what's gone on here? Okay, whilst waiting for you slow typers, elections, John? Yeah, partly elections. And actually, I think this headline, John, is quite interesting because this headline here, US elections, you're right, it adds uncertainty, but actually it's the hurricane and the election that's added doubling uncertainty. Fire alarm dude got a... okay, Will's got a fire alarm going off. Uncertainty, David, you're right. Well, uncertainty is something that traders don't like, and you're right. There's a lot of things going on that we don't have clear answers for. There's no point trying to second guess what the election outcome may or may not be. And if it were a Republican victory, what would it mean for the markets? What would it mean if there was a Democrat election? I suspect the market would be a little bit unnerved if it was a Republican election, mainly because they know what they're going to get with Obama. More of the same for the next 4 years, delivering not a lot, but promising a lot. No, I think it's earnings, actually. We discussed this last week. Generally things have been going pretty well, but the earnings picture has been pretty poor. What these Standard & Poor's companies do, the big index, by the way, is the Standard & Poor's 500, not the Dow. The Dow is 30 stocks. The S&P 500, you won't be surprised to know, is 500 stocks. And it's the top 500 by market capitalization rather than a select band of invited stocks in the Dow 30. Anyway, they were... in the end of the summer, according to the FT, most companies said that they were more likely to miss expectations in third quarter, which is the worst guidance or forecasting that they've given since 2008. And that's pretty much what's been happening, actually. Corporate earnings have been pretty poor so far, certainly the weakest in 3 years. So we've had if you remember, we had, the problems with Google. That was just an amusing tale, releasing it early. Apple, Amazon, McDonald's, General Electric, Intel, Microsoft, 3M, DuPont. I mean, there's a long list of them. And they've really been disappointing the markets. Again, that's unnerved the markets because, if everything had been so good with all this QE, etc., why haven't the markets gone ahead? Really what's happened is the markets have now retraced back most of the gains that were achieved following the Federal Reserve's QE initiative at the beginning of September. So we're in a bit of a pickle now as to where we go from here. trying to work out what sort of bit of good news could propel this market higher. One interesting fact from the FT, they say that a lot of investors have grown accustomed to companies beating earnings figures every quarter. Out of 272 of the S&P 500 posting earnings to date, 62.5% normally exceed their estimates, which they have done over the past decade. But actually, this quarter, to not confuse you too much, this quarter, only 36% of S&P 500 companies have exceeded their revenue forecast. So this is pretty poor, and that's one of the reasons why the markets are setting back. They are not, investors do not feel confident. They realise that all the other problems in the Eurozone and the peripheral Eurozone economies, etc., China's improved a little bit. Japan's not doing that particularly well. Neither are the BRICS, etc. So there is a perception that things are not looking particularly bright at the moment, and the markets tend to take a a longer term view on things. So very much a trend change, I think, has occurred over the last 2 weeks, 10 days, etc. So data. Let's have a quick review of what's happening this week. Best place to go is our Forex calendar, Forex Factory. Let's get back to this week. This week starting the 28th. Okay, 29th, I should say, Monday the 29th. Remember, the red ones are the high impact ones, the ones we tend to spend a little more time looking at. And really the first thing that grabs my attention is the Jap yen. I don't know, anyone trading Jap yen crosses? So that's euro yen, sterling yen, even dollar yen. We have the Bank of Japan interest rate decision overnight tonight, or in the middle of the night, I should say. So that's something that can affect you, Alan. I'm not suggesting you stay up in the middle of the night, but the yen is something that is traded very heavily, especially on the crosses. Bank of Japan's kept interest rates pretty much unchanged since December 08. And the reason why they've kept interest rates unchanged since December 08, because interest rates are at rock bottom levels and can't be cut anymore. Let's just have a quick look at the yen, dollar yen. Here's dollar yen. So it's been climbing. The yen has been losing ground against the dollar. This is the number of yen to the dollar. So a bigger number means the yen has been weakening. Now, there are forecasts that it's going to increase its asset purchase program. They're looking to expand that by 10 trillion yen, $125.6 billion. And they're also going to look to take on more riskier assets. So I think this is probably buying rumour, sell on fact. I'm not sure, but if you look at the daily chart, you can clearly see that the yen has appreciated considerably, certainly since the 1st of October. But you'll note that the outside day on Friday could be construed as being quite bearish. So an outside day, a higher high, a lower low, closing before lower than the previous low, which tends to be quite bearish. Right, let's get back to our calendar. Next bit of news, Mario Draghi is talking on Tuesday. I was caught out a couple of weeks ago. Please make sure that you put this into your calendar. 8 o'clock on Tuesday morning, speaking in Frankfurt, something to do with macroprudential research network of the European systems of central banks. Not something that we'd all tune into and actually take any note of. But he may talk about Greece or Spain, and he may even talk about a potential interest rate cut, which the way inflation is falling, that is more likely in the coming meeting. So that could have an effect on the euro, which, as Adrian, I'm sure, has pointed out to you, is a little bit under pressure this morning, although ranges are still fairly narrow. Okay. Next, we have consumer confidence on Tuesday, which is the next biggest thing. Looking for an improvement in consumer confidence. Where's my little report on consumer confidence? So, with employment picking up, you tend to get an improvement in consumer confidence. People spend more when they're more confident, and they're more confident when their jobs are more secure, etc., etc. So we're looking for a reasonably nice rise from 70.3 to 72. Where have I lost that number? Yeah, to 72.4. So that's a decent pickup from 70.3. Next, we have on the calendar. And we all know this is non-farm week. That's something I forgot to mention. Non-farm payroll employment week, the most important data week, really, in terms of potential market impact. So we have. This is interesting. We have the non-farm payroll on Friday. Everyone knows about non-farm payroll. It's the US's employment or unemployment rate. It excludes farm workers, which are a lot of farm labour tends to be sort of seasonal, etc. So they exclude it, and that's why it's called non-farm. Just looking through the numbers here. 120,000 created in October. Yeah, they're basically saying a lot of this is actually in the private sector. So there's 120,000 is largely in the private sector, which is one of the reasons why the report on Wednesday, we have something called the ADP employment number. Let me just see where that is. Maybe it's on Thursday. Sorry, I do apologise. It's on Thursday. The reason why this is important, because the ADP number is a private sector report, and that actually may help us understand what's going on. It stands for the Automatic Data Processing National Employment Report, and it tends to sort of focus more on the sort of private sector, and that actually could have an impact actually on the markets if it is considerably higher than expected. So ADP employment on Thursday. I'm jumping around a bit, I apologise, but I just want to keep the flow of that particular topic of the non-farm payroll. Really, other than that, our next sort of bit of data really is on Wednesday. That's a very good point. We've actually got some data on Wednesday as well in the UK. Not a lot coming out in the UK, but we've got, or is it Thursday? No, it's Wednesday. No, it's Thursday. I'm looking for manufacturing PMI. Let me have a quick look. Okay, manufacturing PMI. When's that coming out, team? Thursday is manufacturing PMI. I apologise. Okay. Yeah, there we go. And so this is the only real key bit of data, actually. We've had some pretty good lumps of data from the UK, actually, with regards to growth. Obviously, the exceptionally strong number last week, which I think is definitely going to be revised down in the coming months. But nevertheless, the government's got something to cheer about. Manufacturing PMI, still not a great number, unfortunately. Anything below 50 is still in contraction, pretty much in line with the rest of the Eurozone, really. If you remember what happened last week with the German and European manufacturing PMI. So we got a figure of 48.1. Which, as I said, anything below 50 is a contraction. On Thursday, we have, apart from the ADP number, we have unemployment claims again in the unemployment non-farm week. This could be, if it's a number wildly different than expected, it would attract some sort of market reaction. But other than that, I don't expect too much from that. And then in the afternoon, we have Institute of Supply Management, the US's Purchasing Managers Index, contrast the difference, please. Look at the US PMI compared to European and UK. The UK one being expected to be pretty weak at 48.1. The German one slipping, I think last week it was about some 45 point something, but 51.2. So manufacturing sector still expanding in the US. Number above 50 is expansion, below 50 is contraction. So that's pretty positive. I think new orders, etc., etc. The number of components that have pointed to a higher number here, but this particular forecast is looking a slight contraction from the previous month. But anything near that number should be fairly neutral for the markets. Then, of course, most importantly for this week is non-farm. We've had a brief glimpse of it already. 120,000 jobs expected. It's still nothing like enough for the economy that is growing, to confirm the economy is growing. So that still remains a very poor, weak number. The markets are priced in 120,000. They may price in a higher number if that ADP number on Thursday is higher than expected. We did have a surprise last month, though, when the employment rate actually fell to 7.8%. Unfortunately, that's down to people just giving up completely from even registering to be unemployed, and that's more of the reason why the unemployment rate fell. It's likely that unemployment rate will probably tick up a little bit, back up to 7.9%. But it's election time, it's storm time, Frankenstorm. I think at the beginning of this week, I wish it weren't the case, but the outlook is decidedly choppy waters for the markets, not knowing how this hurricane's going to turn out, how it's going to affect the eastern seaboard. It means there is a bit of uncertainty here, and markets don't like that. So I wouldn't be surprised to see further retracement in equities and the risk-off trade. Any questions? Any feedback? Does US risk-off uncertainty and low stocks value necessarily mean higher US currency? Charles, it does not necessarily mean that, but the risk-off trade, what tends to happen is people tend to buy dollars when there is uncertainty. It's deemed to be safer. The link between that and the current US currency and the risk-off sort of scenario is not as clear as it used to be, but typically, the US currency, on balance, you'd expect it to be favoured over the euro, over sterling, etc. Just the way it is. I don't necessarily agree with it. John, could you clarify the term risk-off? Risk-off, John, when we're talking about the markets, I know there are people who are joining this workshop week in, week out. I apologise for those of you who have heard this explanation the previous week. Risk-off really is when investors, asset managers, etc., take risk off the table. Risk basically, in our terminology, means that if we're engaging in risk, we're putting money into riskier assets. Believe it or not, equities are regarded as risk or riskier assets than bonds. Bonds have done very, very well. You're guaranteed of getting your money back. They're safe, especially the core bonds, the likes of the US T-bonds, US T-notes, UK gilts, and also German bunds. Not, I hasten to add, peripheral Eurozone countries like Spain, Italy, Greece, Portugal, Ireland. Do not invest in those. They are not safe. They are definitely risk-on. So risk-off means equities pulling back and bonds benefiting, safe haven buying, the likes of the dollar. So imagine our little dinghy afloat in the English Channel. Risk-off basically means taking shelter and getting out of the choppy seas that will be the sort of peripheral bonds and equities, etc. So that's risk-off, or risk-on, whichever way you want to look at it. Will you be out of the market on the 6th and 7th of November? You're talking about the elections. I mean, to be honest, no, I quite like to react to that. I mean, I'm just sort of wishing to. I follow them quite closely, Will, to be honest. And I don't think the US elections don't really create too many sort of big surprises in terms of market reaction, unless something stupid happens, like the George W. Bush and who's the other character? The pregnant Chaz. Do you remember all those problems in Florida? Was it a vote? Was it not a vote? You know, when it came, the whole US election came down to sort of a handful of voting cards that were they stamped properly or not. Do you remember that? The pregnant Chad. No, I think I tend not to try and get out the market for too long. I like to follow the markets all the time and react to the news. We have our own trading program from our London office that is run using EAs or algorithms, and that trades full time, full bore, 24/7, whenever the markets are open, and only in extreme circumstances do we intervene in it. So, yeah, there are trends to follow. There are market movements. There are actions that we can trade off, and trends, do develop. There are times when, obviously, I don't like putting positions on, and key events, key data points that we've discussed today, you've got to be careful to avoid. As I say, trying to avoid the outcome of a storm and the market's been shut and et cetera, no one knows what effect this is going to have on the eastern seaboard. So it could cause more of a reaction than I'm expecting. In terms of being in and out of the market, I'll be trading it, sure. Anyway, that's it for the time being. Thanks very much for listening. Sun shining, blue sky, God, fantastic. And I hear someone's just got back. I thought we had someone from Marrakesh tuning into our workshops, but it's someone who's got back. Who was that? That was Cliff. Cliff, you just got back from Marrakesh. Yeah, you've come back to the sun here. Charles, is there a website where we can track changes in risk on, risk off? Not really, Charles. It's more of understanding of what is risk on, risk off. I mean, you can set up a board watch, for example. I mean, you could have on a tab in one of your on your quote board here. Set up an additional one, and you can actually put equities, you could put bonds, you can put commodities, and you can put the dollar against certain currencies, and you can see the correlation between all of that. Of course, correlations sort of strengthen and weaken, but generally that correlation exists. You do get decoupling of certain correlations from time to time, so it's not a hard and fast rule, Charles, but equities down, bonds up, commodities down, and dollar up is the normal rule of thumb for risk off. Risk on, equities back up again, bonds down, dollar down, i.e. euro up, and commodities up. So those are the two scenarios, really, just in the round. Anyway, good. I'm glad that you've managed to attend. I hope you've made sense of what I've discussed today. Good luck with the markets for the rest of the week. I think we meet again on Thursday. Neil, thanks very much. Charles, John, Will, Jeff. Good luck with the markets for the rest of the week, as I say, and worth tuning in to either Market Watch or just even the BBC, just to see the outcome of this Frankenstorm. As I said, the US stock market is shut. Electronic trading is not. So the markets will carry on trading. The New York Mercantile Exchange is also shut. It's in the evacuation area, so that will not open. But again, they have electronic trading. So all these markets will trade in some fashion. But as I say, it's likely that the markets will be under a little bit of pressure depending on how this storm develops. Anyway, good luck. Thanks very much for listening. I will put you on hold and then pass you back to Adrian. Will, no, I've been told no electronic trading. Will says I thought they announced that the electronic would shut as well. No, my feedback so far is that the electronic trading is open. Well, I mean, I certainly can see it on the US. Certainly on S&Ps and Dow futures, they're all trading now. But I can't see why they'd shut the electronic trading, because that's something that would really spook the markets. Not being able to trade at all would be a real issue. Anyway, listen, thanks so much for listening. You're on hold for now, and I'll pass you back to Adrian. Thanks very much.